I'll let Steve start it off, and then yeah.
Okay. All right. Good evening, everyone. My name is Steve Gonzalez. I am one of the financial strategists with True Financial. I have the pleasure of hosting Saul Garcia. Saul is an entrepreneur on his own as well, outside of this business. Um, he has a lot of experience, a lot of life experience as well. He's from in the fitness world and does a lot of different things. He's has a young son, and he has a lot of great knowledge to share with everybody tonight regarding one of the strategies that we use very prominently in our business and how it can help people. Without further ado, I'll introduce Saul.
Thank you, Steve, for that great introduction, and we'll just go ahead and get started here. So, as Steve said, I come from the health and fitness background, and that was one of my first passions that got me going into helping people. I really like helping people reach their goals. First it started out with their fitness goals, nutrition goals, looking better, feeling better. And over the last few years, I started to migrate over to the finance world where I can help people feel better in that sense now, right? I can help them reach their financial goals. And it's a really cool parallel because it works the same way in where we have to go in and analyze your needs and see where you're at and see what strategies we implement from where you're currently at. And so I'll talk a little bit about that as we go here, but let's go ahead and get started. Today we're going to talk about whole life insurance. So we'll get started with TrueVeer and our values, right? So TrueVeer almost breaks down into a system just from the name alone. And so first is trust, right? Trust is built over time through consistency and honesty, and it's something that has to be nurtured, right? So naturally, the relationships that we form with our clients are going to eventually build trust as we get to know them, right? So we want to nurture those relationships with like-minded people. And of course, as we get to know someone, we start understanding those needs, the goals, and the priorities, right? Which is essential before we start talking anything about business or products or strategies or anything like that. We got to understand where you're at before we try to set you up with something, right? And then, of course, we're heavy on education. That's why we do these things. We want to make sure that people are educated in what all their options are, right? We don't necessarily like convincing people, right? We want you to see it for yourself. We want you to understand the information, and we want you to know your options and make that decision for yourself because you understand what each of these things and what each of those options are, right? So we're essentially trying to help you create a roadmap. Like, where are you now? Where do you want to be in the next 5, 10, 15, 20 years, right? And a lot of the people we work with are planning for retirement. So naturally, we have to look ahead, but we also have to know where we're at currently. So creating that roadmap is huge. And integrity is at the heart of everything we do. Okay, it almost seems silly to have to say it, but this industry is notorious for, agents doing not the right thing and looking out for themselves and not the client. And we're flipping the whole industry on its head because we are putting the client first. We're very transparent with everything about these products and the strategies, right? And we always want to do right by the client. And our goal is to get you to that resolve, right? That aha moment where you're like, I get it. Like, I see what you just explained, and you're able to regurgitate it back to me in a way that lets me know that you know, right? And now we're both on the same page. And so that's what we're trying to get to here. So I want to start with some common ground, right? Some comments that I hear or have heard over time as I talk to people and some of the problems that come with it. So I just want to put these in your head as we go through the presentation, okay? And the first one is, if something happens to me, my family's exposed, right? That's probably pretty obvious for something talking about life insurance. But the reality is that affects that's not specific to any one group of people. That's literally anyone with a family or anyone that has dependents, right? If you're the main breadwinner, well, there's lost income, any debt is still there, and then there's that uncertainty as to what's going to happen next, you know. The next one is, well, my money isn't working safely anywhere. You know, we're not taught exactly where to put our money to really maximize it, to really get, you know, fantastic returns or anything like that. And so I do talk to people and they're like, well, you know, I don't know how to play in the market. I don't understand the stock market too much, so I don't put my money in the market. So I'm just, you know, my money's not doing anything, but I want to learn, right? So that's the type of people we want to talk to, and we want to educate and hopefully get their money working in the better ways. And then one of the biggest ones is, well, we got a couple other people joining here. There we go. And then the next one, probably the biggest one, is I can't access the money that I have when I actually need it, right? A lot of people have money in retirement accounts, but those are locked, or you have to pay hefty fees if you need to pull money out in case of an emergency or anything like that. Then loans, right? People turn to loans, and they're going to basically have to be go through underwriting, and you know, there's a whole process to that. You can get denied for loans, right? No one has to give you money, and so a lot of emergencies turn to debt inevitably. And at any point during this presentation, just feel free to type in questions or, you know, just shout it out. I'm going to pause briefly and kind of ask you guys just to make sure that we're understanding each other here. So be ready. Oh, come on, there we go. So one thing that affects every dollar we make is taxes and where the money is put into, right? So we have to be very mindful of taxes and where we put it. So let's talk a little bit about that. So there's three main ways your money grows, right? There's fixed, and we'll look at this graph on the left here, where it's consistent, right? If you're growing at 3%, you're not going to grow more than 3. You're not going to grow less than 3. You're guaranteed to grow at 3%, right? Then we have variable. This is something like the stock market, right? Where you have upside potential. The money can go up, but it can also go down. So S&P 500, right? It goes up, it goes down. We see it every day. People make lots of money up, but people lose lots of money as well. So that brings us to the right side here on index. Now, indexed is a very cool strategy, if you will, or a way the money can grow. And in an indexed account, as we look at the graph here, your money can grow and go up, but this green line then stops right here. So that green line stops your money from going any further down. So once you reach that new height and the market starts going down, if you're in an indexed account, you're guaranteed not to lose money, okay? We got, sorry, one more person's coming in. So yeah, your money can go up, but you can't go down. Now that sounds almost too good to be true, right? So this is where I want you guys to pay attention, because I'm going to explain why and how this can be guaranteed, right? So when you put your money in an indexed account, they take that money and they will invest it as if in the market, right? Now, when they invest it, they have a track record of and years of experience that you and I don't. So they know what they're doing. They're able to guarantee that you'll make some money, but they'll cap you. So for example, a typical cap is like 12%, right? So we'll guarantee you won't lose money, but you can't make more than 12%. And that's not every company, right? Some companies don't have that specific ceiling, but they do cap you at one point. And the reason they cap you is because they're going to make the rest that was made, give you your share, and then just be able to guarantee that you don't lose money. Okay. Does that make sense? Because I'm happy to re-explain that if it doesn't. Give me a thumbs up or just hit me with a yes. And if someone actually wants to regurgitate that back to me, I would love to hear it. Clarify it for me. Sylvia, you had you came in and you spoke, so I'm calling on you. Can you explain that one back to me?
Okay, sorry. Explain to you as far as the index, how it works.
Yeah. Does it make sense, right? How they can guarantee you're not going to lose money, but still make money?
Yes, exactly. Yeah, I understand. And that's what I like about this plan because I'm older now and I don't like to lose my money, whatever I'm putting in
Yeah.
there. So, I know it can grow, not much, but it's good enough, it's consistent and I mean, it's guaranteed that I'm not gonna lose it no matter what
Right.
happens. So that's what I like it. Like probably for younger people it's different, but for me it's like I'm getting ready closer to retirement, which that's my goal. And then I want to just make sure that whatever I have is gonna be still there when I need it.
Right. I love it.
Mm-hmm.
Thank you. Thank you.
You're welcome.
Justin, were you going to say
Yeah,
something?
yeah, I was gonna say too. I mean, I think even as a young person too, like I think understanding now, right? And you know, working with all the people I have the blessing and honor to work with, like I'd rather be more conservative, right? I'd rather have not take the risk, right? Obviously, I have some allocation in my portfolio with stocks and equities and whatnot, right? I have some in all three of these buckets that you see here, but I think even just, understanding the mechanics behind these strategies, it's like, you know, that's where a majority of where I'm holding my money, so.
Mm,
So that's just I mean, a little bit of a commentary for me. Like even as a young person, like yeah, you want to take risks and whatnot, but I think as long as it's a calculated risk and as long as but a lot of my reserves are in these types of accounts, that's the main thing, right? So even at that, like I mean, hold a lot of my capital inside of these types of accounts too. So that was just my commentary on that.
yeah, absolutely. Thank you. Thank you. And you're right. We'll get in a little bit into more into why it's good to have this as your kind of home base, right? But let's go ahead and keep going. Thank you, Sylvia. Thank you, Justin. Let's move on to the next part. So now we're going to talk about the tax buckets, right? Taxes are a reality of life, and it's kind of a dark joke, but it's like there's two guarantees in life: death and taxes, right? So as we live through our life, we're going to be affected by taxes all the time, and so it's good to know that where you're putting your money into, where does it fall into, which tax bucket, right? So over on the left, we got the taxable bucket. So we got your stocks, your bonds, mutual funds, savings accounts, right? Those are taxed that year. Now, certain things you have to sell them before you get taxed on it, but right, you're taxed whenever you realize those gains. Then we come to tax deferred, right? That's a pretty common term we hear with retirement accounts, right? Traditional IRAs, your pension plans, 401ks, 403bs, annuities, things like that, right? You're going to pay taxes at a later date. So you get out of it for right now, but at a later date, at a bigger amount, you're going to be paying taxes on that money or when you start withdrawing money from your retirement accounts, right? And of course, the bucket that catches the most attention is tax-free, right? How can we get as much money as possible into the tax-free bucket, right? Well, we have things like the Roth IRA, 529 plans with certain specifications, right? If you know what a 529 plan is. And of course, cash value life insurance, which is what we're here to talk about. Okay, there we go. Okay, so layering your assets and building your portfolio. So we are not, like I said in the beginning, we're not here to convince you to do something. We're here to show you all your options, right? Oh, hold on. Sylvia has a question. Yes, Sylvia.
Sorry, I'm
So
trying
she
to
raised her
unmute
hand.
my microphone. Yeah,
Oh,
can
you're
you
good. You're
explain the
good.
529 account? Can you explain that, please?
Sure.
Thank
Yes.
you.
So 529 plans are a type of savings account that the state offers. I actually have a buddy who sets them up, but essentially it's for your kids' education, right? So it acts like a 401k, if you will, and you can actually convert it into a Roth IRA later on if your kid decides they don't want to go to school. But it comes with a couple different restrictions. So your kid has to use it for school purposes. So if they decide, they don't want to go to school or they want to start a business, well, that money, you can still pull it out, but it'll be taxed. It won't no longer be tax free, right? And so it's not this or that. It's just how much money do you want to put into that, which gives you these restrictions, right? Or is there something with less restrictions that does something similar or better, right? And there's nothing wrong with 529 plans. Again, it's good to have several different eggs, right? Not all your eggs in one basket. But yeah, if you want to know more about 529 plans, I'm actually going to do a kind of comparison on a different presentation about 529, Roth IRAs, IULs, and whole life insurance. So you'll have to tune in for that one. Does that answer your question? Give me a thumbs up there. Perfect. All right, great question. So now layering your assets, right? So it's not this or that. We're not here to talk about the end all be all greatest thing ever. It's about understanding what your strategy is behind the diversification, right? Because true intentional diversification means you understand each product that you have money in, right? You understand the tax implications of it. You understand the returns. You understand the upsides. You understand the downsides. If you just have your money in random places, well, it's diverse, but what's the strategy, right? What's the reasoning? So it's important to be diverse, but it has to be intentional, okay? So now we're going to basically look at how the institution we're taught to put our money into leverages cash value life insurance, right? So the bank, the good old bank. Now the banks, we're taught to take our money, throw it in the bank, put it in a savings account, right? So we deposit our hard-earned money into the bank, and the bank will give us a return if we don't take it out of our savings account. Sorry, Sylvia, do you have your hand up again? The little icon didn't disappear, so I want to make sure.
No, I don't know how to take it off.
It just wouldn't go away. No worries,
Okay.
no worries. Just making sure. Thank you.
Lower hand. Okay, lower hand. Okay, I got it. Thank you. Sorry about that.
Okay, cool. No worries, no worries. Okay, so yes, we take our money, put it in the bank, and they'll give us a very, very minuscule return, right? So what does the bank do with that money? They take our money and they loan it out to other people, right? Credit cards, loans, private loans, whatever, car loans, etc. And you guys know the different APRs, right? We've seen some of those credit cards are like, just unless you got super great credit, and you've never seen those super high APRs, right? But they get up there. And so they're making a good return on the money that we've deposited in that they're lending out. So once they get that money back, right, they're making money on our money. They're going to take that money and they're going to invest it to build and increase their reserves. Now, the BOLI strategy, bank-owned life insurance, is a way to increase your cash reserves. And so that's what the bank does. So the bank buys permanent life insurance on a key executive, a CEO, a CFO, someone very high up in the company that's critical to keeping everything running. And the bank owns the policy. So that means that they can set the beneficiary to be whoever they want. Most of the time, it's going to be the bank. So the bank owns the policy, and they also get the money once the policy is paid out. So sounds a little grim, right? Like you're just buying life insurance policies for your employees, and then when they pass, you're pocketing the money. Now, it's not say that's bad thing because, you know, during the life and employment of that employee, they're able to take money from this asset that they're putting money into, right? And pay the employee benefits, bonuses, whatever else. And it really is to decrease their cost of employing that person, if that makes sense, right? Because at the end of their life, they're going to get this big death benefit payout tax-free. Now, I don't know if you guys have heard of the Rockefellers. Has any of you heard? Just raise your hand if you have. And if you haven't, that's cool. No worries. But the Rockefellers, very powerful family, they're actually very well known for what's called the waterfall method. And it almost works exactly like this, where the trust buys life insurance policies and pays for them, almost like the bank does. And then when the family members pass, that money that gets paid out goes back into the trust, and then it just gets rinsed and repeated, right? And so that's how they're able to accumulate wealth over generations and generations and just have a massive reserve, right? It's a big waterfall. So banks can do it, individuals can do it, and so that's what we're going to talk about here. And this right here is just a quick snapshot of how much money the major banks, you know, you probably bank with one of these banks, how much money they have in life insurance assets. So that's a lot of zeros, that's a lot of commas. So, you know, the institution that makes money with money, puts their money into life insurance, there might be something to it, right? So we're going to look at that a little bit closer as to why. Too many commas. Yeah, too many commas, Steve, exactly. So like I said, the Rockefellers did it, you and I can do it too, right? And there's a reason we use cash value life insurance. We'll get to that in the next slide, but the reasons we use cash value life insurance is because of the benefits that come with it. Now, when you reposition money into a cash value life insurance policy, you get the death benefit, right? So a sum of money that gets paid out to your beneficiaries when you pass, and it's tax-free, right? So there's protection for your family, you get to leave behind a legacy, and they don't have to pay taxes on it, so that's huge. You're able to access the money within that policy. You're able to access the cash value within that policy throughout your life. You don't have to wait till you're 59 and a half. You don't have to wait 5 years like a Roth IRA, right? As long as you have cash value within that policy, you can access it. Okay, so that's pretty cool, especially if emergencies come up or, you know, anything unexpected, as life is full of unexpected things. And then you have upside potential and downside protection. Now, there are two main cash value life insurance products that we'll talk about, but today we're just talking about whole life insurance. And whole life insurance doesn't play within the market, but it still has upside potential, right? Because you're still able to grow, you get a guaranteed growth, and you get dividends on top of that, which we'll cover a little more down the line here. But your money's not in the market, so then there is downside protection, meaning any money you allocate into this product is not exposed to market risk. So you don't have to worry about the money going down, right? Which I think is huge, because everything comes with risk, right? There's always a risk to doing anything. So it's good to have that security. And let's go over, right. And so why life insurance? You know, why, what's so special about it? Well, life insurance in the IRS tax code, you know, the rule book of money, as I like to say, life insurance is clearly printed, and it comes with all these different benefits. Now, I'm not going to go through each one of these, but the tax-free death benefit, right? Taking money out of the policy, tax-free in the form of a loan, right? And it also sets up it tells you the parameters of what constitutes and qualifies as life insurance, because there are rules and regulations that we have to follow. But if anything, that should be more more of a comforting thing, right? Because it's in that rule book. So it's fully legal, it's 100% allowed, and we just gotta know about it to take advantage of it, right? Like most tax savvy strategies. So just want to pause at the common ground issues again, but does anybody have any questions before we kind of dive into the actual product itself? That was just kind of prefacing everything. Give everyone a second here. Going once, going twice. Sold. All right, we'll move on. So, whole life insurance. Let's talk about it. Whole life insurance is very cool. There's tax-free growth, like I said, and that growth is guaranteed growth. Okay, so typically you're going to be seeing 4 to 6% guaranteed growth year over year in whole life insurance policies, right? And because it's a fixed guaranteed return, your money can't go down because it's actually not in the market, so there's no market risk, right? Now, there is the dividend pay and participation part of it. So what does this mean? This means that whatever company you choose to get a policy with, right? The money that you pay into the policy, they're going to take it, they're going to go invest it because they've been doing it for some of these companies over like 100 years, right? And they have a good track record. They know what works, they know what doesn't work, so they know where to put their money to make more money. And then they're going to give you the guaranteed in the case of a whole life, right? But with whole life insurance, you also get a cool feature, which is the dividend pay. So if they have a great year, which again, they have a good track record, so they know what they're doing, they're going to give you a piece of that pie. They're going to give you a little bit extra because you decided to trust your money with them, right? And so that's a cool, it's almost like getting a little dividend pay from a stock, if you're familiar with that. So I think that's pretty cool. And then let's go over here to tax-free legacy and protection. That's just fancy words for saying you get a death benefit, right? So you have that protection for your family, your loved ones, your business, whatever it might be, right? That is the beneficiary, and it's tax-free. So it gets to pass on to those beneficiaries tax-free. No one else gets a cut. The IRS can't touch it. It's all for them, okay? We talked about accessing your money. Well, there's one more slide where we'll go a little more in depth into that. But with these policies, you never actually take your money out of it during your life. You just borrow money from the insurance company in the form of a loan, and they use your cash value as collateral, right? So it's similar to a HELOC. If you guys are familiar with real estate, right? The equity in your home would be like the equity in, or the cash value in your policy. So again, we'll get into that in the next slide. I don't want to spend too much time here on this one, but you can access your money without penalty is the big point, okay? And then it comes with living benefits. Now this is huge because, you know, people hear life insurance, and at least when I first started getting into everything, I always thought, okay, great, like someone's going to get money when I pass. That's great. If I have family or, you know, people I really, really care about, that's great for them. But what about me? You know, what about me? What do I get? I get to pay for this, and then what, right? Well, with whole life insurance, cash value life insurance, you get living benefits. And so living benefits means if a chronic condition falls upon you, you know, God forbid anything happens to us, to our health, but if there's a chronic condition, illness, something that puts you out of work, and you meet the criteria listed within the living benefits, if you meet the criteria of the living benefits requirements, right? Like you have to meet certain disability parameters in order to qualify for it, but they'll give you access to your death benefit, a portion of your death benefit while you're still alive to pay for that very expensive care that, you know, I don't know if any of you here have had to see family go through that or friends go through that, but it's very expensive when someone falls ill or with a chronic condition or a terminal illness. And so that can be a very big financial stressor on themselves, the people around them, their family. And so with living benefits, you have the security of knowing that you can access some of that death benefit, right? Some of that legacy and protection while you're still alive to help you enjoy the rest of your life and just deal with any of those financial stressors that come with that. And then becoming your own bank. That's the segue into the next slide. But before I move on, do all these benefits of whole life insurance make sense? Do any of them not make sense? Because I'm happy to clarify. Okay, thumbs up. Steve, Sylvia, Julian, anything from you, sir? Thumbs up. All right, we'll move on to the next one. I'm gonna just imagine you gave me a thumbs up. Okay, let's go over to becoming your own bank. So becoming your own bank utilizing cash value life insurance. This is just a visual of what I said earlier. It basically works similar to a HELOC with a couple differences. So we're going to leverage the cash value in our policy. Okay, so as we pay into the policy, some of it goes to the cost of insurance, the rest of it goes to cash accumulation, cash value, and that grows over time, right? That's where that 4 to 6% comes in and multiplies your money. So we get to leverage that and we get to borrow against that cash value. So let's just say you have $100,000 in there. Well, you can go to the insurance company and say, hey, I need $50,000 for kids' education, a new car, home repairs, whatever it might be. And they'll say, okay, well, you have $100,000 worth of cash value. So of course, we'll front you 50 and we'll, charge you a small APR because of course nothing is free. But yeah, no problem. They'll give you the money. It'll typically be anywhere from 2 to 5%. But here's the kicker. There's no credit checks. So you have the cash value, you have the collateral, you can pull that money out for whatever you want. Okay, it doesn't have to be for a specific purpose. And I'm not saying this as a suggestion or an idea, but if you wanted to pull money and go to the casino, you could. Probably not a good idea, but you get my point, right? You have the freedom to do whatever you want with that money. And there's no credit checks, no underwriting, anything like that. You just request it from the insurance company. Now, the policy keeps growing as if the money never left. So if you had 100,000 and you borrowed 50 against that 100,000, that 100,000 is still going to grow from that $100,000 starting point in time, right? Give me a thumbs up if that makes sense. I can borrow against my 100, but it doesn't actually remove the money, right? That's pretty cool. Excellent. See some thumbs up. Thank you. Now that you have your 50, well, do you have to pay it back? Not right away and not technically, but you should. Now, this is where the flexibility comes in. You can pay yourself back at whatever speed you would like. So if you don't want to make payments for a year, cool. You're going to take that 5% fee and it's going to add that fee. So you got to be conscious of that. But you technically don't have a repayment schedule. Now, of course, we want to be honest bankers, right? If we're going to make these payments to a bank institution that's lending us money, why wouldn't we do that for ourselves, right? So, of course, you want to have a plan in place. And I actually encourage clients to kind of run an idea by me, especially if it's a sizable amount, right? Like, what are you planning to do with this? I'm going to ask you what your plan to pay it back is, just to kind of put it in your head, right? Like, it's not free money and you got to be responsible with it because it's it's a tool and you got to use it appropriately. But the flexibility is huge because you're not set on a monthly payment. You don't have to worry about that right away. So it's great for investors, right? Who they're going to get their money in 6 to 12 months on the return of whatever that investment is. And they're not forced to have a monthly payment, right? And you can have a monthly payment if you want. It just, the flexibility is great. Then we go ahead and we want to replenish the capital, right? That's us ourselves paying ourselves back. And then we're going to rinse and repeat for the next opportunity. And the money just keeps accumulating and growing. So it's this beautiful cycle. Okay. Thumbs up. Let me know. Good. Perfect. Awesome. All right. So this is where we're going to look at some numbers. So this is the fun stuff. People like numbers. This is an illustration of an actual client. Now I'll break down what each of these, that's a lot of numbers. So that's why I highlighted them. Let me move some stuff here because there we go. So this person's 38, she's 38, and we're going to look at a couple different things here. So in the blue, this is your initial death benefit. So this is how much insurance they have. Okay. Over here on the right, that's the starting number up here. Excuse me. Over here on the right, you can see the death benefit increases over time as the years go. Okay, so that death benefit is going to keep growing, and then that's what gets paid out to your family tax-free when that time comes. In the pink, we have monthly premium and annual premium contract. So this first year, it's $13,928 because of this right up here. So she did what we call a front load. So she took a lump sum of money that she had. She had $8,000 that she wanted to put into this, and she threw it in that first year along with the first year's premium, which is right under $6,000, right? She wanted to keep it about $500 a month. So that's where we get that number from, okay? Now, the other important column here that we want to look at is total net cash value. So that first year, she put in $13,928, right, after her $500 a month for 12 months. And she has access to $12,012 that first year. Okay, so that's, I think I calculated it was about 90% liquidity, okay, which is killer, super killer. Like I should have put in a poorly designed policy just so you guys could appreciate it. But the setup, the build of the policy is critical to making sure that it's working for your benefit, right? And the next page will show that into more detail where I'll break down the cost. But does that make sense to you guys, right? 8,000 in plus the 6,000 for the year at $500 a month. This is how much cash value they have. This is how much they could borrow from that first year. So this would be great for someone trying to consolidate debt, which actually one of my buddies is doing that. He's taking money from his Navy retirement account, and he's going to put it into a policy here and then start taking chunks, paying down that debt that he has, and then paying himself back instead of paying the bank that interest, right? So it's a very cool way to chunk away at debt. And I don't know if any of you guys were here for last week's presentation, but Justin did a great breakdown of a case study of someone that actually got themselves out of like, I think it was like 40,000 worth of debt, right? Yeah, it was a good sizable amount. So, you know, very powerful stuff where you can leverage this policy for many different things. But okay, now that we have all those, let's look at the cost basis of this, right? Because some people would look at it and be like, well, why do I only get 12, right? So let's look at that. Come on, there we go. Okay, so same policy, same person. We're gonna look at a couple of different things here. So this is just a kind of an itemized premiums and benefits. So annually, out of your $6,000 that you're putting in, $1,436 is going to pay for the cost of insurance. So that means that's paying for your death benefit, that's paying for your living benefits in the event something happens to you, right? That's paying for your protection and your legacy that you're going to leave behind. Because these aren't something that you're going to pay for 10 years and then get rid of, right? You can choose how much you can pay up to, but typically people pay these for until they're 65 and you know, until they're in retirement years and things like that. So it's not cost that's going to waste, because you're building up this legacy that you're going to leave behind for your family, or this death benefit that you can access in the event that you get sick or anything like that. So, you know, cost is not always a bad thing as long as you're getting something from it. Now, here in the green is, out of the 6,000, how much is going to your cash value per year? So $4,300 is going to your cash value every year. And then this is that 8,000 that you put in initially. Now this is also a small cost, which, without getting too technical, I'll just show you here real quick, sorry. For the first 10 years, you can see the death benefits start. We have a term rider blend, which just means they give you a little extra insurance for 10 years so that you can fit a lump sum of money in that's going to be bigger than later on. Because again, there's rules and regulations. So that small fee is just an extra little cost of insurance for the 10 years that we're extending that death benefit amount. Okay. If you have clarifying questions, let me know. I'm happy to go into it more. But here's how it breaks down monthly, right? $125 plus $16 is cost, and then 360 of it is going to your cash value every month. So that 500, right? A good portion of it is building up your cash value. Now, we like to show this, and I like to show this because this is where you can see what the agent gets paid on, okay? This is giving you insider secrets here, because no big firm agent is going to tell you this, but this is what we get paid on. So there's ways for us as agents to set this up very, very high, and so that this is very low, right? Because it's still $500 a month, $6,000 a year, but the way you set it up, that's where the integrity comes in, right? Like, am I looking out for my client? Am I going to set this up so it's for their best interest, for helping them reach their goals? And so you want to get an agent that actually wants to see you succeed, that actually wants to help you reach those goals, right? So I don't say that lightly. It's very important. And this industry is notorious for not so great agents doing the wrong thing, right? But enough about that. The last thing I want to highlight here is this is basically the minimum you have to pay to keep the policy in good standing, right? So you can put all the way up to 16,000 in this case in 1 year. So it gives you a big amount of flexibility, right? Like if you have just for some reason life happens and you can't pay the $6,000 a year, well, as long as you can cover this 1,400, your policy's still intact, you still have the protection, and then, you know, hopefully things pick up and get back on your feet, and you can keep contributing and growing your cash value, right? So we can set it up with lots of flexibility, and even if this was too expensive, we could even lower it to a smaller commitment amount. So again, getting with the right strategist is key, because you come talk to us, we can help you increase your death benefit, lower it, whatever, right? We'll work with you. You're not just left to figure it out. Not with us. Okay. Any questions there? That's a lot of money and numbers and information. So any clarifying questions, comments? There's no dumb questions. This is a place to learn. So don't be scared. You can type it if you're scared. How about that? Give you guys a minute. Need some water. All good? Okay. All right. If I see one pop up, I'll answer it. So keep typing if you were typing. Come on now. Oh, what is this? Oh, yes. Okay. Okay, so this is just another example of what I talked about earlier, right? If you have 100,000 in your savings account and you need 50, and it's in your savings account, you can still access your 50, but that 50 is gone because you literally pulled it from your savings account to use. Now it's used, and now all you have left is 50. But if you pull it if you have $100,000 cash value in your policy, you can still pull 50, but your insurance value is still $100,000. So it's still going to grow and compound from $100,000. Okay. So you keep that. Your money never technically decreases, even when you have outstanding loans. Okay. And I believe that, yeah, so that was it. That's basically the end of the presentation. You know, the best time to plant a tree was 20 years ago, but the next best time is now. So don't worry about what you didn't do, but worry about what you're doing going forward, right? So there's a couple people on the team here that are strategists. So you can get with myself, you can get with any of the other guys on here, and I'll actually put a QR code at the end here. You know, we can chat, just have a conversation. We love to recommend resources. These are some different books that talk about the things we talked about today: whole life insurance, indexed universal life, and infinite banking, stuff like that. So if you want to take a quick snapshot of that, go ahead. You can always reach out. We'll give you the number of the names or the book if you're local. Happy to give you a book. And then just a little quick snapshot of our products and services. I don't want to go through all of them, but you know, we have different partners. So if you need help with getting funding, if you need someone to look at your taxes, we have tax strategists. If you have old 401ks, things like that. If you're looking at annuities, right? All those different types of things. This is just a big snapshot of what we help people with. And this is just a list of all our partners, the biggest, best insurance companies that have been doing this, like I said, for a very long time, and they have a great track record of success. And that is all I have for you guys. You can book a consultation with me, or like I said, anyone else on the team. That QR code will take you to our webpage, and you can select our names and pick who you want to talk with, and we'd be happy to take care of you, listen to what your situation is, and see how we can help, you know? And then just real quick, next week, we're going to be going over IULs. So if you want to tune in for that, or if you know someone who might want to tune in for that, you can forward them the email you got today, and we'd be happy to have them on the webinar as well. But now I'll just open up for some Q&A. I know we're getting close to our time here, but I'm happy to answer questions, stay a little longer for you guys.
Thank you. It was
If
very
you don't have,
Thank you.
yes, absolutely. No problem, no problem.
Come on, Julian, I know you're not shy. You can ask some questions if you have some.
Or write down something you learned. How about that? Type it in the chat.
No, it was very clearly presented, and I could understand it clearly. And the front loading was very interesting, and it was clear, you know. And I always had this thought to invest in banks, you know, because now they go on blockchain, and you know, I did a lot of research on that, so it would be a prime time to invest in them. So I saw that. But it was very informative. You know, I'm an elder now, and I miss some of that window, but I've always been very healthy. But I want to, I have a daughter like that 38 that you used as example. See, I have a daughter that's in her 30s. She could do that strategy right there and help herself out a lot, you know. So that's one of the reasons why I wanted to learn more. Now, once I show that to her, you know, and she can deal with people like yourself, because you said integrity is really important. And also you showing how where you're putting your money to, you're constantly gaining some growth, you know. And most people, you know, I tell people you spend $500 on stuff you don't give you any growth. So if you look at it that way and switch your, you know, thought financially, you can always accomplish a lot, you know, with money. So thank you for that. I really it was clear. It's very clear now why I've been saying that I need to do something for my kid, like put 500 into a policy for her, and she can take it over if I pass away, or some type of strategy where it can be paid if I leave here. You know what I'm saying? So you gave me some really good ideas, some clarity on some ideas that I've had to assist her
I love it.
when I'm no longer here. So yeah, thank you.
Yeah, and
Absolutely. I love it.
yeah, and I think one thing to add on there too, it's like we want this to be, used as your own banking system. So in that, what else do banks do is they loan out, right? So I think just to take it a step further, I mean, yeah, we do it in the case study session too, but I mean, we got people on here that have leveraged their policies, including myself, for other opportunities in terms of private loans or in terms of investing and developing that passive cash flow. So I think that's just even taking it a step further. Is like not only is this an asset, but it's also an asset that's going to still continue to grow while you're using it, right? So it's having the dollar do more than one job. I mean, not to go off on a tangent, but I think some of the people are familiar of, I mean, probably everyone here are familiar with using the policies as their own banking system, and not only that, lending it and then making that money or basically generating passive income on top of that. So, so this was a great breakdown in terms of the mechanics and looking at how a front load is very, beneficial when it comes to a policy and how that can actually basically just jump start it or supercharge it in a way. So I think you broke it down really well in terms of, the actual mechanics behind the whole life policies.
Yeah, I would agree.
Thank you.
For a novice like me, I mean, it's why I'm really interested, because every time I see one of your shows, I get clarity on how to do this. And that's, my daughter's pretty good with her savings or money. So I think by introducing her to you guys, because Steve, he's an uncle, we that close, she can jumpstart herself, and provide for some type of legacy for her and her daughter. So that's what I'm looking forward to. And you guys are showing me how to do that. So that's why I want to say thank you. I'm glad I came on. Usually I'm asleep because I work graveyard. But this was worth it, man. I mean, really, it cleared up a lot of stuff that I didn't know. And but I'm quick. So I was clear on how everything worked, So thank you.
Well, absolutely. You're very welcome. I'm glad we could bring you some clarity and bring you some value. Well, if no one else has anything, I'm gonna make sure we all get out of here on time. And thank you for listening to me. Sounds like some people learned something. And I'll do another one in a couple of weeks, but tune in to IULs for next week. That's also another great tool. So like I said, invite people. We want to expose people to the information because knowledge is power, right?
Yeah. One other question. I know your slide's probably proprietary, but is there a way to get a copy of some of that? I take notes, but is there some way to get a copy of some of that you presented tonight?
Yeah, I think we can send out the recording actually.
Yeah. We'll send out the recording.
Okay. Thank you.
Yeah, absolutely.
Appreciate
talking to
everything.
you, Julian. Thank you.
Yeah, have a great evening. Thank you.
Thank you so much.
Thank you. You
Appreciate. We'll see you
too,
next week.
Sylvia.
Bye-bye. Thank
Bye.
you. Bye.
All right, everybody. Have a great night. See y'all next time. See you
Good
guys.
job, Saul.
Got to run. Thank you. I'll talk to y'all soon.